Welcome to the Deep Dive, your essential briefing on the latest earnings calls. We sift through the numbers, the commentary, everything, really.
Yeah, we pull out what you actually need to know.
Exactly. And today we're diving into Energizer Holdings Inc., the battery people, but also car care stuff too.
Right, Armor All STP, that's them as well.
We're looking at their Q3 fiscal year 2025 results call. Our goal today, pretty simple. Distill the key insights, maybe flag some surprises.
Oh, there were definitely surprises this quarter.
And basically help you quickly grasp the takeaways from what felt like a pretty significant quarter for Energizer.
Pivotal, I think, is the word. Management actually used the phrase decisive inflection point. And, the market seemed to agree. Big positive reaction.
A really strong signal, then. It suggests maybe this turnaround story we've heard about is finally clicking.
Looks like it. The groundwork seems to be paying off in a tangible way now.
Okay, so let's get into that. What did this inflection point actually look like in the numbers? Let's do a quick snapshot first, because this was, a really strong quarter.
Absolutely. Let's start with adjusted EPS earnings per share.
Yeah.
Came in at $1.13.
Okay. And the expectation?
The consensus was just 61 cents.
Wow. So what's that? An 85% beat?
Exactly. An 85% beat on the bottom line. Huge surprise. And DAP EPS, the standard accounting number, also strong at $2.13.
That's pretty impressive profitability. What about the top line, the sales?
Revenue also beat. It hit $725.3 million. The expectation was more like $693.2 million.
So about a 4.6% beat there and up year over year, too.
Yep, 3.4% growth compared to last year. So solid demand, good execution.
But the thing that really jumps out, I think, is the margin story here.
Definitely. Adjusted gross margin was 44.8%. That's up 330 basis points year over year.
330 basis points. That's a serious improvement. Shows real gains in, cost management.
Yeah, managing their costs of goods, manufacturing, supply chain discipline, it's all shown up there.
Okay, and rounding out the key numbers. EBITDA, cash flow.
Adjusted EBITDA stood at $171.4 million, and year-to-date free cash flow was $16.5 million.
So you put all that together, the big EPS beat, solid revenue, the margin expansion, it makes sense why the market reacted so positively.
For sure. It really felt like a shift in sentiment. Investors have been, kind of cautious on Energizer for a while.
Right. So this quarter seems to signal that maybe the strategic plans are finally bearing fruit, moving from just talk to actual results.
Exactly. And a lot of that comes down to their big initiative, Project Momentum.
Okay, let's talk about that. Project Momentum. The CEO, Mark LaVigne, he really emphasized this was the driver behind these results, didn't he?
He did. It's basically their multi-year plan to transform the company.
And what are the main parts of it?
It's got three main pillars, really. First, restoring margins, which we clearly saw this quarter. Second, investing in growth areas. And third, building a more agile, flexible operation.
So this quarter was kind of proof of concept that they can deliver on all fronts: growth, margins, earnings.
That's exactly how they framed it. Delivering organic top-line growth, strong margins, and robust earnings, all firing together.
Okay, let's dig a bit deeper then. What were the key drivers within that? They mentioned category resilience, some innovation.
Right. So even though consumers are, being cautious, feeling the pinch a bit, the core battery and lighting categories held up pretty well. Auto care was a bit softer, they said, maybe due to mild weather impacting certain products.
But the innovation piece sounded interesting, the new Podium Series batteries.
Yeah, that's a big push for them, the premium line. They said it's already in 15,000 stores, which is apparently ahead of their initial plan.
So this isn't just selling more standard AAs. This is different.
Exactly. It's a strategic pivot, moving towards higher value specific niches. They mentioned things like performance gaming accessories, industrial tools, areas where maybe Duracell isn't as focused.
Ah, okay. So trying to carve out some higher margin space away from the main competitor. Smart.
Seems like it. It's about playing smarter, finding those growth pockets.
Now, probably the biggest headline, the thing that really moved the needle this quarter, tariffs and these production credits. What's the story there?
Huge story. They reported a material improvement, their words, in the expected hit from tariffs. The actual rates are much lower than they feared.
Okay, that's good news. But they also have a plan to offset whatever impact remains.
Yeah, a comprehensive plan. It includes pricing adjustments they've already made, internal cost savings, and the big one, these production credits. They expect to fully offset the tariff earnings impact for both fiscal 25 and 26.
Let's talk about those credits then.
Yeah.
Section 45X production credits. What exactly are they? This sounded like a potential game changer.
It really is. Basically, it's part of the U.S. Inflation Reduction Act. It's an incentive for domestic manufacturing, specifically for batteries in this case.
So they get money back just for making batteries in the U.S.
Pretty much. Yeah. And it's substantial. They expect it to add $35 to $40 million annually to gross margin, net earnings, and free cash flow
Annually? Wow. For how long?
through about 2032. So it's a really significant long-term tailwind.
Okay, that's huge. And there was a one-time benefit this quarter, too.
Yes, a big one. $112 million recognized this quarter relating to these credits. And crucially, management confirmed they don't need extra investment to keep getting these credits. Just keep producing.
So it just drops to the bottom line, essentially. Incredible.
It's a fantastic structural advantage for them now.
Okay. Another strategic move mentioned was an acquisition back in May, APS NV, a Belgian battery firm.
Right, that added about $21 million in sales this quarter. They expect maybe $40 to $50 million for the full year from it.
Any profit impact yet?
No bottom line impact expected this fiscal year, they said. But strategically, it's important. It boosts their in-region for region manufacturing, making products closer to where they sell them. Gives them supply chain flexibility, expands their European footprint, and helps with key retailers over there. It fits this pattern of optimizing their global production.
Makes sense. Okay, so with all this good financial news, how are they using the cash? What about capital allocation shareholders?
Well, they returned a good chunk to shareholders in Q3, $84 million through dividends and buybacks, plus another $27 million repurchased in July.
They seem quite active on the buyback front.
Yeah, they opportunistically bought back 2.8 million shares. That reduced the share count by about 4%, and they highlighted doing it at an average price around $22.
Which, given where the stock jumped after the call, looks like pretty good timing, shows confidence.
Absolutely. And while they still say debt reduction is a priority targeting below 4 times leverage, they also stressed flexibility. They saw value in their stock and pivoted to buybacks instead of just rigidly paying down debt. Shows they're actively managing capital.
And what about spending on the business itself, CapEx?
That's expected to normalize, come down to roughly 2% of net sales over the next couple of years. They had a period of higher investment in production and digital stuff, but that seems to be easing.
So even with maybe some temporary inventory builds they mentioned, things like new packaging transitions, the cash flow outlook is strong.
Very strong. They're projecting free cash flow generation of 10–12% of sales over the coming years. That's a healthy number, gives them lots of options.
Okay, so given all this momentum, they raised their guidance for the full fiscal year 25.
They did, yeah. Net sales growth now expected between +1% and +3%.
And earnings.
Adjusted EPS guidance bumped up to $3.55 to $3.65. And importantly, that includes the benefit from those production credits, about $40–45 million worth.
Got it. And EBITDA.
Projected between $630 and $640 million. They sounded really confident about hitting these numbers.
And they even hinted beyond this year.
Yeah, they signaled continued earnings growth into fiscal 26, basically saying this updated 25 outlook is the new baseline to grow from, like algorithmic growth going forward.
That's a strong message for longer-term investors. Okay, so stepping back a bit, thinking about the investor context. How do they see themselves competitively now?
They position themselves as the best-positioned battery business globally, leveraging their brand portfolio Energizer, Rayovac, Ever Ready, and their manufacturing network.
What about private label? Is that hurting them?
Interestingly, they said private label growth was flat in their categories, and their overall market shares were stable. Pricing actions they took earlier for tariffs seem to have stuck with retailers and should help in Q4.
And how are consumers behaving? What's the outlook for Q4 leading into the holidays?
Consumers are still cautious, definitely looking for value. That might mean waiting longer to buy, switching channels, maybe buying smaller packs.
But batteries are pretty essential, right? Especially around holidays.
That's their point. The category is resilient. You still need them for remotes, toys, all that stuff. That provides a floor.
Any issues heading into Q4?
They mentioned retailer inventories are slightly elevated, but that's baked into their guidance. They expect Q4 shipments to be a bit lighter because some holiday demand, like 4th of July and Prime Day sales, got pulled forward into Q3.
But the full-year sales view is unchanged.
Correct. Full year is still on track. They expect the battery segment to perform in line with the overall outlook and maybe see some recovery in the auto care side.
Okay, so thinking longer term, this decisive inflection they talked about, what are the key things listeners should watch for next to see if this momentum continues?
Well, Obviously, the next earnings report, Q4 results, and the full guidance for fiscal 26, which comes in November.
Right.
Also, just the continued confirmation of those production credits rolling in each quarter. See the integration of the APS NV acquisition proceed smoothly.
What about product launches?
Definitely watch the ramp up of the Podium Series distribution. They need that hitting shelves strongly for the holiday season, which they think might start earlier this year.
And on the financial side?
Further debt paydown is key. If they can get that leverage down, maybe regain an investment grade rating, that would be a big positive signal.
You mentioned earlier the market narrative could shift.
Yeah, if they can keep delivering this kind of performance, say mid-single digit organic growth, executing on costs, the story could change. It might move beyond just margin repair
To what?
to viewing Energizer as potentially a cash compounding staples disruptor.
Okay, cash compounding staples disruptor. Let's unpack that phrase. What does that mean?
Well, cash compounding means consistently generating strong free cash flow, like we discussed. Predictable cash generation in a stable sector, consumer staples.
Right, and the disruptor part.
That suggests they're not just sitting back, they're actively innovating, like with Podium, and optimizing, like with the manufacturing credits, to shake things up, gain share, and drive growth differently than maybe a typical sleepy staples company.
Interesting. So a more dynamic growth story emerging from a traditional base. And that could lead to...
Further multiple expansion. Investors might be willing to pay more for each dollar of earnings if they believe this new, more dynamic growth narrative.
Got it. Okay, let's shift gears slightly. Now, this next bit is purely for informational and entertainment purposes. Absolutely not financial advice. Clear disclaimer there.
Crystal clear. Not advice. Just thinking out loud.
But putting on our speculative hats, given this decisive inflection point, the strong market reaction, that long tailwind from the production credits, it does make you think, doesn't it?
It does. You've got the Section 45X credits providing this clear boost to cash flow through, what, 2032? That's a long runway. You combine that with a push into higher margin innovation Podium, the specialty stuff from APS NV, and this whole cash compounding staples disruptor idea. Well, it suggests there could be more room for the stock's multiple to expand, maybe beyond what analysts currently expect.
And you also have the fact the company showed it's willing to buy back stock when it thinks it's cheap, like they did around $22 before this call. That kind of provides a potential psychological floor, maybe.
Potentially, yeah. So if you were constructing a purely hypothetical trade idea, again, not advice,
Definitely not advice.
you might consider something like longer dated out-of-the-money call options, maybe expiring in 12, 18 months with a strike price, say 15, 20% above where the stock is now.
So a higher risk, higher reward bet.
Exactly. Betting that the market fully catches up to this fundamental transformation story and the sustained cash flow generation over the next year or so.
Interesting thought experiment, but again, folks, just informational, not a recommendation to trade.
Absolutely not. Do your own research.
Okay, so let's recap the key points from today's deep dive. Energizer delivered a genuinely strong Q3. Big beats on earnings and revenue.
Driven by their Project Momentum strategy finally hitting its stride, those really significant Section 45X production credits kicking in, and smart moves like the APS NV acquisition.
And the market noticed. A strong positive reaction suggesting renewed confidence in the turnaround and the future growth path.
Yeah, a real potential shift in the narrative for the company.
So, our final thought for you, the listener, to chew on. Think about what this means more broadly. Could Energizer's playbook, leveraging manufacturing optimization, government incentives like these credits, plus targeted innovation, be a model for other traditional consumer goods companies?
Are we seeing how legacy brands can fight back against macro headwinds and actually reignite growth? And what does this mean for competition, particularly in the battery space? Some interesting questions to ponder.
Indeed. Remember, everything we discussed today is for informational purposes only. It is definitely not financial advice.
Please consult with a professional before making any investment decisions.
We'd love to hear your thoughts on this Energizer story, or if you have suggestions for future deep dives, let us know.
Thank you for joining us for this deep dive. Please subscribe, share it with your network if you found it useful. Stay informed.
Until next time, stay well informed and keep digging for those valuable insights.